half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne with Annabelle Droulers.
Our top story, Asian stocks rebound led by Japan after a brutal sell-off on Monday. The yen snapping a 5-day rally, slipping more than 1% against the dollar. Also ahead, China's sovereign yields rise from record lows, with state banks said to sell bonds in large chunks. As speculation continues, the PBOC may intervene in the market. Plus, we continue our exclusive coverage inside Adani, speaking to Gautam Adani's eldest son about claims the family fortunes are too closely entwined with the Modi government's.
Being close to a political party does not necessarily mean that you get the work. You get the work because you are able to deliver.
All right, buckle up. It's certainly going to be a wild ride here today after that dip, savage dip that we saw yesterday. We are continuing to see this rebound. So a bit of whiplash, to say the least, here today. Take a look at how Japan is faring, and there you go. We're seeing that recovery of 10%. So almost recovering from all the losses that we saw yesterday after the worst day that we saw since 1987 for both the Topics as well as the Nikkei. We just got that line on our terminal there. Circuit breaker for Topics futures have been triggered given just the surge in amount in terms of the price action there in the last few moments or so. Kospi is also doing quite well. We're seeing gains about 5%. Taiwan coming back online after the worst plunge that we've seen in 57 years. There you go. We're up about 3.5% or more in Taipei. What really dragged that was TSMC. We'll see how that pairs out. But dollar, strength coming back just a little bit, right? You take a look at how yen is doing, right? We're 145.31. So at least the unwind of those carry trades seems to be fading just a little bit here. Euro dollar, though, we're still punching about a 109 level. There's still more bets that maybe the Fed might actually cut more aggressively than the ECB now. And treasury yields at least are heading higher. So there's a bit more stabilization here. Recovery, maybe some sort of turnaround is underway here. We're 4 basis points higher on the curve for the 2 as well as the 10-year. RBA, no, still sort of watching that what's going to go happen there when it comes to the Aussie 10-year yield. So yields there are still ticking slightly lower. JGBs, though, are following the Treasury's trend here. We're watching Brent markets very closely. It seems like for now we're close. I think we're back to around those February levels for Brent, that we might be close to wiping out those 2024 gains. But there's a lot of political risk that maybe we're not quite positioning for as well. Copper is continuing to see, when it comes to China futures, are lower here this morning. So we're not quite seeing that rebound fully in the commodity complex here today. You flip the boards. Obviously, we're watching the big moves that we saw yesterday. How are we seeing it? Is it a mirror image from what we saw yesterday? And yes, there you go. TSMC is seeing a pop of 7%. Interesting note from Morgan Stanley on TSMC too about the ADRs. About it's one of their prime picks still amidst this volatility right now. Topics. We had the Topics banks basically plunge to a record yesterday. We're seeing gains of 10% here right now. The insurance index as well. Massive moves to the upside. And Bitcoin as well recovering about 3%. Around 56,000 levels here right now. Your approach to the open is looking like this here. So we talked about possible intervention. Some traders are telling us that, we did see those yields pick up in the CGB market yesterday. We continue to see that for another day. 216 for your China 10-year yield after we briefly touched that 210, 211 level yesterday as well. And futures there are pointing positive. Still some strength in the currency, 714 right now. And so therefore, today it looks like we are maybe starting to see a turnaround Tuesday here today. Can this last? And really, is the coast clear? You take a look at how the S&P, basically after we saw that tumble from the peak, we're talking about we're on the cusp of a correction after the NASDAQ basically hit that milestone last week as well. Of course, that ISM services number may have actually put a floor and maybe pare back some of the losses there during that session. But still, a lot of questions are still lingering. Let's bring in our chief equity strategist at Bloomberg Intelligence, Gina Martin-Adams. She joins us now from New York. Gina, it's great to have you here on the program. Just given the veracity that we're seeing across equity markets here right now and this rebound that's underway in Asia, do you actually buy this sort of rip right now?
I think it depends on your perspective as an investor. Usually 10% corrections come around about every 9 months on average in the long-term history of the S&P 500. And we all know that stocks tend to rise over time. So typically a 10% correction is a pretty good opportunity to put money to work for investors with a longer term time horizon. But timing the exact low is a near impossible task. I do think that we've still got some valuation excesses in the U.S. market that need to be worked off, in particular with respect to tech and tech adjacent stocks, where we just exhibited extreme premiums, and some clear weaknesses emerged over the course of the earnings season with respect to expectations being far too high for these companies. So our work would suggest that that premium still, the gap between the tech stocks and the rest still needs to close somewhat, and it may need to close through sort of further time consolidation for the tech space. But the rest of the S&P 500 is trading around its pre-pandemic norms, so not a ton of valuation excess left in the market. And at the same time, we've reached pretty extreme oversold levels. Markets tend to recover after major oversold. So at least in the short-term perspective, if we can get some good news out of Asia today, I would expect that to feed through to the U.S. market tomorrow.
But how much excess are you talking about when it comes to big tech specifically? Because there's just been such a concentration risk around these names as well. And it seems like, given that dominance of the Mag 7, people are so nervous to even put their money to work in the S&P 493.
Sure. Yeah. So I think on the first question, how much excess is still there? We wrote a report last week, actually, talking about the 4,344 reasons why tech faces impossible expectations. That 4,344 is the basis point excess that tech was demanding in terms of valuation premium to the rest of the market. So that's a very, very hefty premium relative to long-term average. We've removed about 10% of that, right, with the downdraft that we've experienced. So we've got to have either some catch-up in the rest or some deceleration or just time consolidation in tech. Tech can earn their way out of the premium as well. And some catch up in earnings with some slower price action can be a way that that manifests itself. So I think that we want to consider that. In terms of the 493, I think this is an excellent question. Something we've been watching really carefully as well is through the first half of this year, really last year as well, and then the first half of this year, the Mag 7 and the big cap tech stocks were really the only source of optimism on the index. This is part of the reason why the premium evolved, is this is the group that was producing the earnings growth. And so the expectations got a little ahead of themselves. We got a little too optimistic. This was the earnings growth segment of the index. That earnings growth is now slowing somewhat. Still earnings growth, but at a decelerating pace. 493, on the other hand, the rest of the stocks that have kind of been left behind that not a lot of people wanted to own, investors were kind of shunning them in favor of the Mag 7, that 493 is starting to experience some degree of earnings growth. That also tends to be the more discounted segment of the S&P 500. So if investors can get a little bit more confident that that earnings growth of the 493 will be durable over the course of the next several quarters, that the consensus view or the analyst consensus is correct and this group will show accelerating earnings growth, that can go a long way to kind of soothing the market's woes. But that's not going to happen overnight. It's not going to happen in a day or two. That's going to have to happen with companies guiding us to expect better growth and to confirm analyst expectations. That could take a little while and could take the duration of the quarter before we can really start to see some real momentum emerge in this space.
If there's still more money to come out of big tech, how does that leave the markets in Asia that are particularly correlated to what happens in the US? I'm thinking about Taiwan and Korea in particular, especially given their exposure to AI and the hardware sector in particular.
Yeah. Well, big cap tech in the U.S. is not all hardware and semis. I think that there's a couple of nuances that are really important to consider here. And that is when you look at Taiwan and Korea, you do have incredible amounts of tech exposure, but very different tech exposure than you have in the U.S. tech space, or even in the China Tech 8, for example. So I think you want to be really careful not to sort of paint everything with one big brush. There was one big trade, and that was AI and AI-related stocks. But as we're already seeing through earnings season, the market is starting to distinguish somewhat between earnings winners and earnings losers, between companies that are meeting expectations and able to surpass those expectations and companies that are not. I'd say one consistent theme really throughout tech is margin. And the companies that are telling us that they are not experiencing any margin pressure or likely to experience any margin pressure going forward, where they're likely to see continuous margin gains, those companies are generally doing quite a bit better than the tech companies that are telling us that they may have to spend or right-size spending, change CapEx plans. They're starting to talk a little bit about margins, and that certainly makes the market very nervous. So I think you want to distinguish each tech company from the other and be really careful at this point, after we've seen such a correction, not to paint every tech stock with one big brush globally.
All right, Gina, great to have you on the program. Thanks for staying out for us. Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence. You take a look at what's been really gone in Japan, and that's really where you're seeing where those signs of maybe things were maybe looking a little bit more too far when it comes to this route. And really, earlier we were talking about these RSIs, and Bell, really, they were already flashing oversold yesterday. So maybe we were primed for some sort of recovery here. And obviously, after we saw volatility basically shoot to a record yesterday, we'll watch very closely how these volumes and how that plays out here. But yes, we continue to see U.S. futures are still punching higher here this morning. So yes, maybe some signs of calm coming back. But really, what really started all of this is certainly the key question. Let's bring our Bloomberg opinion columnist, Garo, ready. You've been writing your column about, oops, maybe the BOJ did it again. I mean, are we likely to blame Japan for really this market rout, Garo? What's your take on it?
So I think rather than Japan being to blame, certainly the rate hike last week was unexpected and definitely didn't help, and probably one of the reasons that you're seeing such oversized moves in Japan compared to some other markets. But in terms of the BOJ doing it again, what I'm talking about there is the signal that Japan gives off. So historically over the last 30 years. You can use Japan hiking rates as a pretty good indicator that a recession is going to come, because they have a tendency to hike rates at exactly the wrong time. And I think that is one of the things that we saw with last week's rate hike, which I think a lot of people did not expect to happen so soon. The BOJ has been very cautious under Ueda, moving very slowly to unwind the stimulus that his predecessor had put into place. He had moved very slowly, far more slowly than people initially expected when he came into office in April 2023, if you recall. And then all of a sudden we've gone from 0 to 60. They've just slammed on the, they've done 2 hikes in the space of a couple of months and threatened to do more. I think what we've seen, even with the recovery today, I think what we've seen in the markets over the past 2 days is definitely going to give them pause going forward and say that, well, maybe they might have overestimated how much the Japanese economy can actually withstand, even what is in relative terms a very small rate hike that we saw last week.
How much do you think they're going to need to factor in the thinking of retail investors, because they were really hit hard by that rout yesterday, and you think about even the government, for instance, has been pushing Japan citizens to get into the stock market, dip their toes into it. If they end up really whipsawed in this, does the BOJ now need to take that into account when it thinks about its hiking moving forward?
Yeah, I think that's a very good question, and it is one of the things that the bank is going to have to think about. I think one of the issues with Japan, quote unquote, normalizing policy is that we don't necessarily know how consumer sentiment is going to be affected. Japanese consumer sentiment is used to deflationary environment. They're used to prices going down. They're used to interest rates being 0 or below 0 over the past, 15 years. If not longer, indeed. So one of the things that I think will be giving people pause is precisely as you say. The government has really been pushing the NISA tax-free investment accounts. They expanded the amount that each individual can invest at the start of this year. They've been pushing them very heavily because they want to get people out of having savings sitting in the bank, not earning any interest, and instead having them active and putting them into investment, especially to help make up for what are expected to be shortfalls in pension payments as the country ages. Now, when you have a market crash like yesterday, I think maybe regardless of what happens today, what you might end up seeing is that you might end up seeing consumers saying, well, hang on, this investment thing isn't everything it was cracked up to be, and they might be more cautious about either their investment or their spending. And I think that's one of the things that people need to be careful of, especially as we might see higher mortgage rates going forward if the BOJ does continue to hike.
Yeah, I mean, does it create that negative feedback loop? We're questioning that with the Fed too. I mean, just given the market route here, does it actually feed into the economy and really reinforces some sort of recession out of this? Rout, thank you so much. Rout Reddy there, our opinion columnist, joining us out of Tokyo with a little bit more context on what really could be behind these violent moves that we're seeing across these markets. Still ahead on the China show, we'll discuss what the Fed could do as it faces calls for an off-cycle rate cut ahead of the next meeting in September. We're going to have more analysis from BNP Paribas Asset Management's Zhikai Chen. Next, we're also counting down the opens of trade in Shanghai, Shenzhen, and Hong Kong. Looks like a recovery could be underway here. Are we really seeing a bit more bright spots in these markets here? And really, is there still that buy the dip mentality that continues across this Asian session? We'll see how long that lasts here. The reference rate just coming through 713.18 against the dollar here. Futures are pointing in the green this morning. This is the China Show. All right, we're taking a look at how these futures are pointing positively here this morning. So I think we can all kind of breathe a sigh of relief, at least for today. That may be the worst, may be over. We'll see. Key question we're asking all of our guests here today. 215 for your Chinese 10-year yield. So we are still seeing a bit of those CGBs on offer here today after signs of maybe some intervention. Maybe. We'll see. Let's bring in Zhikai Chen, head of Asian and Global EM Equities at BNP Paribas Asset Management. We're still licking our wounds, really, from the last two sessions right now, Zhikai. I mean, how are you assessing all this here right now? Is it overdone? And is this really time to be dip buying?
As whether it's overdone, I think that's the trillion-dollar question that everyone is asking right now. I think we saw very sharp moves yesterday, led by in developed Asia, if you will, starting from Japan into Taiwan and Korea. We saw several markets trip circuit breakers at that particular point in time. And I don't think there's a single trigger, in my opinion. I think it's a combination of, say, very strong positioning in popular trades that we've seen in Asia over the last, say, 6 months to even a year, and obviously a very favorable carry trade that was forced to unwind in very rapid succession. That probably triggered a lot of the selling. If you look at some of the mega caps within Asia, ex-Japan as well, be it TSMC or Samsung Electronics, you clearly saw that there was very sharp movements downwards on very, very big volumes. That also suggests that potentially yesterday was a day that people sold what they could rather than what they want. So it's good to see that today we have a rebound in the markets, and hopefully this breaks the fever. But I think we're still in fairly uncertain terms at this point in time, given that in some of the regional markets, we're actually still doing quite well on a year-to-date basis, and investors are sitting on profits might be taken to take some off.
We were just speaking with Gina Martin-Adams from our Bloomberg intelligence team, and her view, at least for US big tech, is that there's still money that needs to come out of these, and they're still looking too pricey, those names. You've been very positive on the IT hardware sector in Asia in particular. Are you sticking with that call?
Yeah, we're still sticking with that call. And I also heard that conversation you had with Gina. I think one of the things that she pointed out that was quite interesting is on margins, right? And if you look at the current quarter earnings results, I would say the earnings on a fundamental-wise and cash flow-wise looks good. They met expectation. Guidance, generally speaking, were better than expected. I think for a lot of hardware tech, one of the key anchoring reasons for us to be positive is that for Asia, we are the supply chain for a lot of this AI requirements, if you will. And from that particular perspective, the outlook on the revenue side still looks pretty good, because you still see a lot of these bigger hyperscalers committing, even escalating their capex increases into this particular front. So that gives us a pretty good roadmap in terms of the order flows that's coming for hardware tech, at least in Asia.
A lot of it has to do with the Fed discussion, too. I'm just wondering, earnings are certainly one thing that is disappointing on the AI side, Zhikai, but there's now calls of maybe we need some emergency rate cuts from the Fed. At what point should we start to worry that this creates that sort of negative feedback loop, right? If we're going to see continued market sentiment that is weak, is that going to feed into the local economy and force the Fed to actually act more aggressively?
Fair point. I think there's always this concern that the market takes on a life of itself. When you have very sharp movements within the market, you have negative impact the wealth of the investors in the US, and that has a knock-on impact onto the consumption, the consumer confidence, and therefore consumption. But I guess that I'm actually happy that I'm not in a position to make that call. The issue that I think we see right now is that a lot of the concern is that whether the Fed has basically held rates too high for too long, and therefore creating a too tight a liquidity environment that could actually constrain and indirectly cause a recession. I think they're probably likely to move. I think the last FOMC also indicated that they're guiding the markets to expect cuts probably in the September quarter, depending on the data. The recent labor market survey data also is probably giving us some room for that, given the dual mandate that the Fed has. But from a personal opinion perspective, and obviously I'm not an economist from that perspective, right, I don't think the Fed should intervene with emergency rate cut or resurrect the Federal Reserve put, if you will.
Zhikai, just quickly, Chinese stocks pretty much defied the slump on Monday. Do you think there's room to run on that sort of outperformance, even from a valuation perspective?
I think valuation definitely looks attractive. We've been adding incrementally towards China over the course of this year, as we've seen the market correct. I think it goes back to my earlier point on positioning. If there's a very crowded trade in some of the favored markets from that perspective, then the correction obviously will be very severe. But yesterday, because the Chinese market has not been a favored destination by investors in globally or Asia, the market actually reacted quite well, and also given valuations as well.
That was Zhikai Chen there, head of Asian and Global EM Equities at BNP Paribas Asset Management. Thanks so much for your time this morning, and we'll have more ahead. This is Bloomberg. All right, we're calling this Turnaround Tuesday after that market meltdown on Monday. We are seeing a rebound coming through in the Asian session so far, being led by those gains in the Japan there. The Nikkei topics trading up near 10%. How that's looking for the mainland Hong Kong session ahead, we are seeing futures pointing again a little bit more positively here today. But of course, China pretty much withstood that sell-off yesterday, so perhaps not needing that same level of correction for today. More ahead. This is Bloomberg.
Welcome back. You're watching the China Show. We're counting down the open of markets there. And there you go. Much more green on the screen here today. And we are seeing a bit more of a recovery here after what was pretty ugly yesterday, right? The carnage that we saw. So you're certainly seeing North Asia doing quite well. We're counting down to an RBA decision here as well. And of course, even CGB seeing a little bit of change in the narrative too in the last 24 hours or so, Bill.
Yeah, well, certainly it does seem, at least from the China eco perspective and that question around assets, that the PBOC is getting more control as well over the direction of the Chinese yuan. But the setup today, it's been really an interesting dynamic because Chinese assets largely sort of shrugged off all of the turmoil in global markets on Monday. Today in the session, we are setting up for a little bit of positivity here across the screen, but not expecting to see any sort of major jump here at the open, given we didn't have that extreme sell-off in the session on Monday. So the CSI 300 coming online today, upside of 0.8%. But as we said, really a lack of correlation between what we're seeing in mainland and other markets. What's interesting to note actually in the session on Monday was that we saw foreign investors actually turning net buyers in Chinese stocks as well. Quecho Motai, for instance, trading up 0.9%, one of the key beneficiaries in that. But broadly, you are seeing here moves in the green. Chinese yield, of course, to be noting here, trading at 2.16. It was around that 2.10 mark yesterday in the session as well. What we're tracking in Hong Kong markets in particular is that outperformance or look for the Hang Seng Tech Index here. You're trading up 2% so far for that gauge versus the 1.25% gauge or gain rather, for the Hang Seng instead. Again, really a lot of broad moves here to the upside. You've got the likes of Tencent, Alibaba, for instance, in the tech space, trending around 2% higher. Movers, of course, to note, because we do have that Chinese earnings season still underway here. And we've got the likes of Fuyao Glass, Tektronic, War, for instance, some of the names on tap for today. Yum China, big pop here. We actually saw that one beating what had been expected by analysts, Yvonne.
Yeah, we'll see if it matters, right, this time around, just given where we've really been caught between these macro crosswinds through and through. Let's bring in our MLS strategist, Mary Nicola, to walk us through this recovery that we're seeing. You know, obviously things are stabilized, but, you know, do you think the coast is clear right now, Mary?
I think sentiment's quite fragile still, and I think there's just signs of fatigue in the sell-off, because considering how violent the sell-off was yesterday, we're seeing some signs coming through overnight that were showing some signs of fatigue. You saw that in just the way that they were performing with the Japanese futures index. The Hang Seng futures were also showing signs of fatigue, and they were also picking up some steam. But in general, without a clear catalyst for a clear turnaround, it's hard to see this, that we're completely out of the woods. What we should expect is just a lot more volatility coming through.
And where do you think then, if you are expecting further volatility, where do you think that leaves Chinese stocks in particular? Because they've largely been uncorrelated to what's happening in global equities.
Yeah, it has been interesting to see how Chinese equities have been performing. And a large part of it is what we've been seeing is that momentum coming through has just been an unwind in positioning. And we do have to remember that in China equities, there has been a lot of under ownership in China equities, especially by foreign buyers. So it's not like they're clearing out any positions. In fact, they've been relatively insulated. So some of the big things that have seen wild moves have been things like yen carry trades, especially against the Mexican peso, which has had a lot of steam to it over the past few months and even years as well as where we have seen Japanese equities, where they have been a big buyer and big opportunities there, where funds have moved in that direction. So I think because of the fact that China equities have been under-owned, they've been a little bit more protected.
You've also been talking about some of the data that we got in the U.S. overnight. That, you know, we had a guest yesterday from IG, Tony Sycamore, saying, look, that ISM services number, that might provide a floor for these markets. And we certainly saw a little bit of that in the U.S. session. I'm just wondering, does that help us give a bit more clarity on what's really driving, you know, the last two sessions? Is it really about the fears of a hard landing, or is it more about other things, you know, when it comes to market positioning?
I think where we saw and just how the markets unfolded yesterday, the momentum was too strong for anything to overtake. So even if we saw ISM blowing it out of the water, it would have done something, but not enough to really reverse that trend. What would have happened is if we did get a very negative ISM number or a downside surprise in the ISM, I think that would have just made things a lot worse, and we wouldn't have been opening the way we have been today, because it would have heightened concerns over a hard landing. But the fact remains that the data is showing that the hard landing isn't there. The hard landing narrative still for the U.S. isn't there, but it is pushing, it is heightening concerns about just where the U.S. economy is headed, and especially for this region where the implications become even bigger, because then where does the growth come from? Because if China is slow and the U.S. is slow, how does the Asia region respond to that?
That was our Bloomberg MLive strategist, Mary Nicola, there. And as we said, just heading into the start of trading for mainland equities and watching what's happening in the bond space in particular, because we're seeing bond futures here, Chinese bond futures, just dropping around the most we've seen in about a month. You've also got yields that are on the move as well, lifting off those lows from yesterday. And that's after we actually had some reporting, or Bloomberg being told that China's state banks have sold government debt in large batches. And again, that move is something that could help pull benchmark yields up from record lows. For more, let's bring in our China correspondent, Min Lo. And Min, just talk to us about this story in particular. And again, that market reaction, it seems like it's already coming through.
Yes, so state banks were told have been offloading 100 million yuan batches of the 10-year bond. That's according to 3 onshore traders we have spoken to. These are notes issued in May, some of the most actively traded in the CGB market. We also understand that these banks have also been offloading huge batches of the 30-year bond as well. And that's why when you look at the yield yesterday for the 10-year bond, it briefly dropped below the record low of 2.1% before erasing those losses and hitting a high of 2.15% amid that selling. And this really came after months of speculation about exactly when the PBOC is planning to intervene in the market after repeatedly warning about an overheated bond rally. And we've seen the PBOC really being torn between trying to arrest that rally and trying to lower interest rate to reduce borrowing costs. And traders have been watching intently about how the government is going to tackle the longer end of the yield curve, because the shorter end has been pushed down by those interest rate cuts. They have PBOC have prepared hundreds of billions of yuan in bonds to sell, and they've done so very gradually now.
How much does the external picture change? I mean, I'm looking at the Fed pricing and people talking about emergency cuts from the Fed now that are necessary. Does that widen the window a little bit for the PBOC to cut rates further?
Yeah, exactly. You're right. I mean, we're already seeing for the first time in the year appreciation pressure on the yuan, and that really opens up more window for the PBOC to act. And it's because of the unwinding of the carry trade, as we've been talking about, but also because of positive policy signals about the government looking to boost consumption, for instance. And our Bloomberg economics team is forecasting a rate cut in the fourth quarter of 10 basis points, but the chances, they said, of a 20 basis point cut before the year end is also growing. And this means that the US-China interest rate difference is going to narrow, the dollar-yuan yield spread is going to narrow, and it's good for the Chinese economy, because that's been the biggest obstacle for the PBOC to cut rate, is that exchange rate stability. And with US possibly falling into recession, it's a perfect window of opportunity for the PBOC to cut.
Thank you, Min Lo, there, our China correspondent, with the latest when it comes to these CGBs here this morning. And coming up, we're going to go and continue our coverage of Inside Adani, our exclusive with Gautam Adani's eldest son, about claims of family fortunes are too closely intertwined or entwined with the Modi government. We have that interview coming up next. This is Bloomberg.
More now in our exclusive series taking you inside India's Adani Group. Karan Adani is billionaire Gautam Adani's eldest son, and he oversees businesses including cement, ports and logistics. Together, those provide much of the critical infrastructure, allowing global companies to plug into India's $4 trillion economy.
Yep, and Adani is now planning to take over seaports in the Middle East, Africa and Southeast Asia as it tries to challenge China's dominance in key trading infrastructure. In our exclusive interview, Karan Adani also dismisses allegations, and the group's fortunes depend on their close ties to Prime Minister Narendra Modi.
This man holds the keys to one of the biggest logistics businesses in Asia. Karan Adani is the eldest son of Gautam Adani, the Indian billionaire who built a sprawling infrastructure empire that's pivotal to the country's economic ambitions. He's been handed the reins to some of the most important businesses for the Adani Group, including ports. Karan is visiting the Mundra port in India's Gujarat, the home state of Prime Minister Narendra Modi, whose policy priorities the Adani Group has closely tracked as part of its business strategy. Mundra is where it all started for the group, which is now India's biggest private operator of ports. Maintaining and building on that growth will be a key challenge for Karan. He is one of the 4 family members handpicked to run big chunks of the Adani empire as part of his father's succession plan. However, the firm's meteoric rise has been overshadowed by accusations it's benefited from cronyism. It also took a multi-billion-dollar hit from the explosive Hindenburg research report, with a short seller claiming the Adanis engaged in fraud and stock manipulation, allegations that they've denied. Bloomberg's Anto Antony sat down with Karan Adani for an exclusive interview and asked him about the challenges ahead.
The group's rise has been closely linked to Prime Minister Narendra Modi, but at the same time you are working in several other states with other governments also. How do you do the balancing act there?
Being close to a political party does not necessarily mean that you get the work. You get the work because you are able to deliver, you are competitive in a market, and we have run it in a most efficient manner. You don't have these three things, there's no point being close to any political party, or because today's India is no more about giving favors. It is all about whether you're competitive in the landscape or not.
Many of the investments which the group is making, whether it's in Sri Lanka or Israel, the way in which many analysts are seeing it is like you are playing a strategic role for the government of India to facilitate certain trade routes. Now, as a group, you balance the requirement to serve a strategic need and at the same time maximize profit as a publicly traded company.
So I think certain positions that we are taking is also strategic for us as a company, because going back, we do see that there's going to be continuous disruption. And we look at where are the major trade routes from India and how do we minimize those disruptions by having a position over there. So that is the first fundamental one. And second is obviously if you look at from a geopolitical perspective, yes, India has certain geopolitical priorities, but that doesn't mean that those priorities are companies' priorities. We take our individual assessment. End of the day, we look at risks, we look at profitability, and for us, family is also one of the largest shareholders. So we have to do justice to the family as well, apart from the minority shareholder, because end of the day, all the investments that we are making, whether it is in power or whether it is in ports, these are investments which have to give returns on a standalone basis.
Adani Group is known for chasing scale. What would be the global ambition like as you oversee the business over the next couple of years?
I would not say we have a global ambition. I think the ambition is by 2030 we want to be handling at least 1 billion ton of volume, predominantly coming out of India, because as India is going to grow, the trade is going to grow, and obviously and we are in the right position to take that sort of growth. I think the second part is to give a reliable supply chain solution into our neighboring countries and making India as a center point of that whole supply chain. And that is the idea, that how rather than cargoes getting transshipped in Dubai or in Singapore, how do we make India as a center point of the overall supply chain from east to west? And that's where we are looking to play, to create that larger vision of making India as a center point. Wherever we do believe that we have to take a position, we are happy to take a position over there.
When the Hindenburg short seller attack happened, it must have taken a lot of management bandwidth and mind space away from chasing this vision. Now, how did you deal with it personally, and what role specifically did you play at that time?
So at that time, basically my responsibility was three things. One is obviously to make sure that business resilience continues, not just in ports but across the group, in terms of our performance, in terms of our operational efficiency, in terms of our capex efficiency. So that was number one. Second was to ensure that from a leadership perspective, we were completely aligned. There was no critical people leaving during this time, and they were ensuring that we were all working together to achieve the goal, to make sure that we weather the storm. And that's what that was a main priority, to make sure that whatever performance parameters that we have achieved in the past, we beat that during this period.
One overhang, even right now, is the kind of investigations or probes which are there into the company. And also at the same time, there are allegations regarding opaqueness in the holding structure. How do you assuage the investor concerns on this front?
See, I think if you look at from investor perspective, right, as a group, we went through this transition from 2007-8. So if you remember, in 2007-8, we had a holding structure. We had Adani Enterprise, and then we had all the other companies which were subsidiaries of it. And again, going back to getting feedback from the investors, they said that we would like to have a clean structure. And that's where we started demerging. So ports got demerged, Adani Power got demerged. So basically the shareholders who want to invest in ports, they know that they come into APSZ, or investors who know that they want to only invest in energy, they know that they want to come into renewable. So one is, there is a clean structure from a holding perspective. So there is no crisscross holding which is happening. So it's a very clear structure. Family holds directly into each of these entities. Second is, when you look at from a family perspective, family holding perspective, all of that has been disclosed, because we have 23 or 25 international issues, bond issues across various group companies, again rated by all international agencies, investment grade rating. And part of it, unless you don't disclose all of this, there's not much of, you don't get through that hoops of getting that rating. All of that has been disclosed. And coming to investigations and other things, where the issue would come is if, as a group, we have not disclosed something. All the investigations that so-called Hindenburg report has been talking about is all disclosed, whether it is in our annual report, whether it is in our bond issuance, or whether it is in or any of our IPOs as well. So if you remember, before Hindenburg, just before Hindenburg, there were 2 IPOs which we did. I mean, demergers we did. One was the demerger of Adani Total Gas, and then the second is again the IPO of Adani Wilmar. Now all of this, SEBI will not give you clearance if you have certain issues going on.
Your father is a first-generation entrepreneur who, from the scratch, built one of the largest conglomerates in the region. When the transition happens, for you to step into his shoes, those are some pretty big shoes to fill. How will you go about it?
As you move from first gen to next gen, I mean, we realize that what they're leaving us behind is a sort of a legacy, as well as not just a business, but a platform which we have to protect and ensure that we pass on to the next generation as well. We also realize we can't work the way he is working, in the sense that his risk appetite is much higher than what ours is. So we realize where our shortfalls are, where our strengths are, and we work on our strengths, and whatever we have learned from him, all the wisdom that we have learned from him, we try to work on it on a day-to-day basis.
But hunger for growth is something which differentiates Adani Group from many others, as Mr. Gautam Adani has said. Now, risk appetite is a key part of it. Why are you saying that in the second generation, the risk appetite could be slightly
It is bound
less?
to happen, right? So this is evolution of life. First generation, you have grown from nothing. Your risk appetite is much higher, because even if you lose everything, you're back to where you had started. We are starting from a level which is something higher than what they have started. So we have a larger responsibility to make sure that we protect and to grow from there.
Mr. Gautam Adani has talked about the middle class values that the group espouses. Now, the second generation has mostly born into wealth. Is there a pressure to come
I would
forward?
differ over there a little bit, because we've not been born into wealth. A large part of our childhood has been through a struggle as a family. It's just that in the last, 15-20 years is what we see. But a large part of our childhood has been of struggle. We have seen our parents struggle everyday basis. We have seen them go through tough times as well as good times. We have seen them aspiring for more and working hard. And we have seen them dream together to reach to that aspiration. And we have also seen a lot of support from the larger family, and more importantly, valuing what we have.
That was Karan Adani there, speaking exclusively with Bloomberg's Anto Anthony. And of course, our special coverage of the Adani Group continues all week. Tomorrow, we're going to hear from Gautam Adani's nephew, Sagar, who oversees the group's power and finance businesses, about the fallout from that Hindenburg report.
From our viewpoint, purely this report was nothing but accumulation of everything that was written and alleged over the last 10 years before that, but also very beautifully gift wrapped and presented in a way that was, explosive and shocking.
Our coverage continues with the special report on Friday at 11:30 a.m. Hong Kong time with an encore presentation at 7 p.m. That's going to be 4:30 if you're joining out of Mumbai. We got plenty more ahead. This is Bloomberg. Continue to check, of course, these FX markets, and we are starting to see a little bit of that carry trade come back in some ways here. So some weakness in the yen here this morning. We're just back to those 144, 145 levels here. Also watching that Mexican peso. So yeah, that strength coming through. So that unwind of the carry trade seems to be reversing just somewhat here. We're also watching that Aussie dollar just ahead of that RBA decision here, set to be more of a hawkish hold, according to most economists out there.
Yeah, and of course, ahead of the RBA, watching what's happening in the bond space as well. The Aussie 3-year yield, the 10-year yield, just moving a little bit lower. 10-year yield, or rather the long-term 30-year yield for China also in focus. We've seen moves to buy up bonds as well to try and stabilise and put a floor under where they've been heading. Japanese 10-year yield, of course, also a watch.
All right, coming up the next hour, we're talking with markets with Pepperstone Group's Chris Weston about this rout and this recovery, plus Elara Capital on our Adani coverage. Welcome back to the China Show, Hour 2. And yes, we are looking a little bit better in terms of how sentiment is here after 2 days of really carnage across these risk assets. And Hong Kong certainly, being a little bit more insulated, I guess, from some of the macro side of things when it comes to China markets. We're still doing decently well here, up 0.6%. But you're seeing more of that momentum in Japan, the Koreas, the Taiwans here this morning, although those are also coming off some of the highs of the session here so far, Belle.
Yeah, that's right. I was actually just looking exactly at that. Yes, so we are seeing a bit of a turnaround in the session so far today. But certainly the magnitude of the losses we're not seeing really being recovered so far in the session. The Nikkei, for instance, you're up around 9%. It was a correction of more than 12% yesterday. The Kospi, Taiwan as well, you're just back below those gains of around 1% at this point in time. So broadly, you've got the gauge up around 3% here. Really still those concerns are feeding through not only of where the Fed goes next, and you're even hearing calls now that the Fed needs to act to hike out or ahead of its next meeting in September. There's also concerns around big tech, those valuations, are they still too excessive, and how much concentration risk there's been as well. What we're seeing, if you change on now, as we said, not everyone is really buying into this notion of let's buy the rip or buy the dip. Bill Gross, for instance, is saying that he's not getting involved in this, what he deems to be a small recovery. If you take a look at some common risk proxies, the likes of the Aussie versus the Japanese yen, Mexican peso as well, you are seeing, again, those moving a bit higher, but not versus the losses that we saw yesterday. Bitcoin as well, another good proxy here, given you're up around 2.5%. But yesterday, again, it was a significant slide. Another way to track this is what you see in trading volumes, for instance. Yesterday, those were extremely elevated, around 95% in some corners of the market, more than 100% higher than they would typically be on a 20-day moving average basis. Again, you are seeing trading volumes elevated today, but they're giving up somewhat. You're now around 15% higher than where you would be on a typical Yvonne 20-day moving average basis.
Yeah, certainly you're not seeing as much, I guess, ferocity when it comes to this rebound. I think people are still scratching their heads about really what to do. Can you really kind of lean back into those popular trades like big tech, the like here? Let's bring in Chris Weston, head of research at Pepperstone Group. He joins us from Melbourne this morning. Chris, it's been a busy few days. It's been a lot of, I guess, breathtaking few sessions here. I just wonder, your morning call here today was interesting, right? You said buy the rip after this dip. What separates you from those saying, this is a start of a new regime, and makes this really something of more of a blip, what we saw on Friday and yesterday?
Yeah, I mean, I think that, I think momentum is the way. And I would like to let the market confirm that the buyers are in control here, because, if you look at Japan today, excuse me, if you look at Japan today, I mean, implied vol in volatility in the Nikkei. And the Nikkei VIX essentially is still 50%. I mean, it was high yesterday at 70%, which was extreme volatility, as we've seen. But, at 50%, the market is still priced for near 3% daily moves over the coming 30 days. So, we're still net out of the woods. And I think, if we're looking at the market today, I would like to see... we can look at futures, but on the cash market, I think we'd probably like to see the yesterday's gap being closed into 35,880. So we've got a bit of work to do, really just to show that the buyers have stepped up, because after the massive liquidation that we saw yesterday, a lot of leverage has been taken out of the system. We know that there were a huge amount of margin had been used to buy equity positions. We can talk about the carry trade as well, but obviously, a lot of that has been liquidated. There's been a lot of false selling, and that needs to settle down. And I think it's really brave to come out and start, wading in as an investor into banks. I think, we're seeing a tradable rally today, but have you got the visibility and the calmness and the answers that you need to really give you the conviction? Because that's what we do as market participants, whether you're an investor or you're a trader. You're trying to price the future, you're trying to price risk, you're trying to price certainty. And right now, after the liquidation, I still think that the market's got too many questions, and the answers aren't going to be happening for any time soon. So this is a day traders market at the moment. I think the investors, you've got to be very brave to be looking to wade back in right now.
Do you think part of the difficulty, Chris, is that we've had such a concentration in big tech, and investors perhaps are still not quite exactly where they want to go just yet? We saw that rotation into the small caps, for instance, into more of the defensive place. But do people really know where they want to put their money to work as well?
Well, absolutely. I mean, what we've seen, and it's been a slowly, and then all at once. It's just the rug pull that's happened, and it's been an exercising in positioning 101, and there's just been a rush to the exit door at one go, and a lot of that has been obviously forced positioning. So there's really been very little opinion in that. It's just been dictated to by the amount of leverage that you've got in the system. We've seen that in the Japanese margin traders, all-time highs levels there. But there has been a huge concentration of positioning in big tech, AI-related names, in the carry positions as well. I would argue that a lot of that positioning has been flushed out. I think in still big tech, there's still a lot of core legacy longs that still need to work themselves out of the system. But I think if you're looking at carry, that position has been reduced quite dramatically. I mean, the trade-weighted yen's had a significant rally since the mid-July lows. But I still think there's money to be there's positioning that needs to come out, and of course people are looking now and saying to themselves, well, if I'm out now, I'm not going to come out now. A lot of the damage has been done. People have looked to hedge. I wouldn't be looking at hedges now. I think that train has completely left the station. Implied vol is very high, skews ridiculous at the moment. Yesterday we saw 1 month puts trading 14 vols premium to calls. You can buy IWM downside call, downside puts. They're trading at 35% volatility now for 1 month IWM puts at the moment. So a lot of the hedging mechanisms in the market are very, very expensive at these levels now. So I think you're going to sit out and just ride it out. Maybe take a bit off the top and just see what happens. But where do you go? I think the question is what is the circuit breaker in the market? And that circuit breaker from the Fed isn't going to happen for 6 weeks. We're going to be looking at the data next week from retail sales. I think that'll be really important, just because so many people now subscribe to the recession trade. I think calmer heads are prevailing now. So we're at risk of just chopping around in a bit of a consolidation, waiting for that data to just give us clarity on that recession. And secondly, then, the circuit breaker has to come from the central banks, where we've pushed the central bank, or pushed the markets, pushing central banks to take the action that we see. And if they don't deliver that action, then we'll see higher volatility again.
Yeah, it brings a question that Fed put. I mean, if people are talking about, look, we need something off cycle, that we're going to need, outsized cuts of 50 basis points in September and November, like the likes of JP Morgan and Citi are saying here right now. I mean, does that help in terms of putting a floor across this markets, or do you think it actually, leads to more fears of a recession?
No, the Fed put's great, and it was it was a really nice comfort pillow, effectively, a comfort blanket, sorry, when equity markets were positively trending and we saw low volatility playing through in markets, and we knew, the Fed, if we're going towards a soft landing, then that Fed put really gives us that insurance that we need, and why sell equity in that situation? And we just sell volatility and enhance the returns that we're getting. But if we genuinely are going to a recession, and we'll have to see what that recession looks like, then the Federal Reserve can chase the market, and they can come out and take the Fed funds rate below the neutral rate. I'm not sure how effective that's going to be, because they'd have to take that far below the neutral rate, and they'd have to potentially even use liquidity. So, it really depends on the data now, and how close we are going to get to that recession that's going to really determine where that floor price on the Fed put is. I think where we've seen a situation in years gone by where the Fed have to cut to stimulate because we are going to recession, then rate cuts haven't been that panacea that we've been looking for, and the Fed have to use their balance sheet and liquidity measures to cause that V-shaped bottom in risk. But for now, look, I think we're in a situation where a lot of people have subscribed to a recession trade. We'd seen rate situations really overdone, over 50 basis points, talk of emergency cuts, or intermeeting cuts. It's not going to happen. And I think we've probably gone a little bit too far in that situation. We just pared it back, and I think we're in a realistic pricing mode in Fed funds futures and in swaps pricing. It's all about the data now, and just to see how bad this could get, or if markets have gone too far on the recession trade, because we saw that in the ISM services numbers last night. They were pretty good. We're going to get retail numbers next week, see how they go. But GDP is tracking around 2.5%. It's not that bad at the moment.
I mean, Japan certainly bore the brunt of this sell-off. I'm just wondering, just given the fierce reactions that we've seen and just the speed of which we've seen this price action, Chris, I'm just wondering, does it prompt some sort of reset of this market, which, just months ago people were saying was undergoing some renaissance? If I see the yen surging 12% over a matter of weeks, I mean, that certainly does change the earnings prospects of some of these companies.
Yeah, it does, and it changes the hedging dynamic as well. I mean, if you're a corporate treasurer, it's a nice world to be in when you've got a slow grind in the yen and you can hedge those risks. Or if you're an international money manager and you're looking to hedge your foreign currency, it's fine when you've got a slow grind. You can get those hedges on without any problems whatsoever. But when you've got the rate of change doing what it's done, then it just makes hedging prospects just that little bit more troublesome. And markets are moving so quickly that it just creates that level of uncertainty. And obviously, what we're seeing is a massive dispersion in views and outcomes, and that's where you get the volatility. Is just people just can't price risk in this market, and obviously liquidity has come out the market, bid-offer spreads have widened a touch, and all of these factors just cause just see exasperated moves playing through. But I think what we've seen there is just a rush to the exit all at once, followed by options dealers having to manage their hedging flows, CTAs flipping long on the yen. It's just been happening all at once, and it's created this incredible move. But I feel what we've moved, and a lot of that positioning's flushed out. We've got that reset, and I think from what happens from here is what it's going to be very, very interesting indeed.
Chris, always great to have you. Chris Weston there, head of research at Pepperstone Group, joining us out of Melbourne this morning. Still ahead, more from our exclusive coverage taking you inside the Adani Group. We're going to ask Gautam Adani's eldest son about succession and the fallout from that Hindenburg short seller report. That interview coming up next. This is Bloomberg.
Taking a look at how Aussie assets are faring here ahead of the RBA rate decision later this morning, and that presser, of course, ahead. You are seeing bond yields here just tracking lower, so really just sort of catching up to what we've seen in global assets. What else we're seeing is Aussie stocks. Again, they're just moving a little bit higher. Aussie dollar just fractionally stronger or firmer against the greenback so far. But the RBA is expected to keep its key rate steady when it announces that policy decision in just a couple of hours. Bloomberg Economics, as well as says the central bank is likely to stick with its hawkish stance. Let's get more with our economics reporter, Swati Pandey, here with us. And Swati, I mean, we had that softer second quarter CPI print last week. It pretty much cemented the decision for the RBA today.
That's right. There was a lot of nervousness ahead of that inflation report. It came in below expectations, but remember, it's at 3.9% core number, which is still pretty high. The RBA's target is 2 to 3%, so it's closer to 4% at the moment. So the RBA is still likely to be worried about that price impulse in Australia. It just takes away that pressure from them to raise interest rates, but they are likely to remain hawkish.
Yeah, I mean, just everyone seems to be signaling cuts now, right? Whether it's the Fed, we had the BOE. I mean, all these developed markets are basically undergoing their easing cycles here right now. Do you think that the RBA in some way is looking at the external picture and really factoring in maybe they need to still maybe start talking about rate cuts, or do you think they're still going to keep that possibility of a rate hike on the table still?
I mean, look, Michelle Bullock will do a press conference at 3:30 p.m. Sydney time today, and she will definitely be asked this question. It is something that's on everybody's mind, and I'm sure it's on the RBA's mind as well. The RBA always says that they are not in lockstep with global central banks, but you are in a global world, and you cannot really detach yourself from what's happening elsewhere. And what we have seen in markets in the past few days, central banks tend to overlook those things, and in some ways they are also going to be kind of relieved about it too, because there was a lot of fraudiness in the market that they were worried about. So the fact that we are seeing a bit of sell-off in the market is likely going to be all right. I guess the problem for them will be if there is contagion or if there's a big financial collapse or something like that. So at this point, the RBA will probably sound a little bit more relaxed than it did last time, but they still need to sound hawkish. And I think it's too early still for them to talk about interest rate cuts, even though financial markets are pricing in the first cut in December. It's unlikely that they discussed a cut today.
Do you think, though, that the RBA is at risk of really sort of getting stuck in a bind then, because they were late to hike and they're also likely to going to be later to cut as well? Are they going to get a little bit stuck here, especially when you've got the ramifications of it? Things like consumer confidence, for instance, is weakening in the country.
Yes, the impact of the RBA's rate tightening cycle is being heard the loudest in the household sector. And that is the sector that's actually been crying for some relief as well. So RBA has been late in the tightening cycle. So we are at 4.35%. As if you compare that with the Fed or with the RBNZ, they are well above 5%. So the RBA will probably be okay if the Fed or the RBNZ or other central banks cut rates and kind of bring them back to where the RBA is. If you look at our real rates, real implied rates, we are still around 0.35%. In the US, it's like 2 to 3%. So there is a bit of an experiment that the RBA is doing here, where it wants to preserve the job gains. It wants to prevent a recession to happen. And whether that is successful or not, we will find out. But the RBA is definitely in a hard position at this point.
Swati, thank you, Swati Pandey there, our economics reporter joining us out of Sydney ahead of that RBA decision. Of course, you can turn to your Bloomberg for more on this. T-Live Go is up and running to get commentary and analysis from our expert editors as we count down that decision from Michelle Bullock and co. Plenty more ahead. This is Bloomberg. Checking oil markets here this morning, and of course we're seeing a little bit more of that geopolitical risk premium putting back onto these markets here, of course, as we brace for maybe a possible retaliation from Iran following these escalations that we're seeing in the Middle East. You take a look at how year to date, how oil prices have been, though. I mean, we've bounced back of what has been some of these 7-month lows. So taking us back to really levels that we saw back in February, if not even close, even wiping out the gains of this year. In some ways, you could say that, geopolitical risk hasn't really been a big factor here. Maybe the macro slowdown picture is certainly what's weighed on oil prices here as well. Is that the right call? Certainly, it's one big question we're asking our guests here this morning. But the U.S. says it's working with allies to head off a potential Iranian attack on Israel. They're urging all parties to refrain from escalation to avoid a wider regional war. For more, let's bring in our news desk editor, Jill Deesa. She's here with us in our studio. So what did this push by the U.S. and its allies involve?
Yes, Yvonne, there's a lot of moving parts here, but ultimately to try to sort of, de-escalate tensions in the region, you had the Biden administration moving additional forces into the region. You also had Secretary of State Antony Blinken meeting with top officials from Qatar and also from Egypt. Those are the two countries that have really been taking the lead in trying to negotiate some kind of a ceasefire here. So all of these moving parts, trying to sort of calm tensions here. Jordan is also involved to a certain extent. You've got Iran talking to Jordan, a foreign official there. You've also got Biden talking to King Abdullah. So maybe there's some sort of broad efforts here trying to make sure that there's not a further de-escalation of conflict in the region.
And you mentioned, of course, Iran talking. We know that they've vowed retaliation of some kind. So what exactly have we heard on that front?
Yes, Val, I think at this point, so the latest you've heard from Iran is essentially that, again, they're blaming Israel for the death of this top Hamas leader that happened last week. Israel obviously has not confirmed or denied involvement in that, but that's really sort of escalated tensions here. At this point, though, I mean, we've been hearing these kinds of talks or this kind of this threat of this escalation for several days now. So that's ultimately just led us to where we're at now, where we've got just so many different stakeholders in this trying to, sort of cool tensions within the region before this actually develops into some kind of really massive retaliatory attack.
And where do broader efforts stand now when it comes to some sort of ceasefire?
Well, at this point, Yvonne, you've got Biden. The Biden administration is obviously talking to Netanyahu about the idea of, some sort of a ceasefire, to sort of quell tensions within Gaza, try to, stop these tensions between Israel and Hamas. And that's really just between the U.S. and Arab states here. That's widely seen as really the pathway toward cooling tensions in the region, creating some sort of peace. But we haven't really seen anything that's really moved forward significantly on that front yet. Just this idea of trying to stop things from escalating before there's some kind of a retaliatory attack from Iran.
All right, that was our news desk editor, Jill Deesa, there. And here are some other top global headlines that we're tracking this morning. US Vice President Kamala Harris has reportedly narrowed her search for a running mate to two candidates, Pennsylvania Governor Josh Shapiro and Minnesota Governor Tim Walz. That's according to Reuters, which also says Harris is set to announce her decision by Tuesday. The Democratic National Committee plans to virtually nominate a 2024 presidential ticket this week. Bangladesh's army chief and president are calling for calm after Prime Minister Sheikh Hasina fled the country following anti-government protests. Authorities say a curfew will be lifted on Tuesday and that elections will be held as soon as possible. Hasina had faced pressure to resign for weeks as peaceful protests over government job quotas turned deadly.
We're taking a look when it comes to China markets here this morning, and we talked about, maybe we're shielded. Are Chinese stocks really that safe haven? Certainly, when you take a look at how things are looking like here today, the CSI 300, we're now back to negative territory. In fact, that Shanghai Composite, we actually were seeing, about a 1% gain. Just a few minutes ago, we basically erased that. So right now, we're really focusing on the domestic side of things to really see what drives this market. But yes, we're flat when it comes to the Hang Seng here. We're just trading around that 16,700 level here. In terms of the tech trade, there is a bit across HS Tech here this morning. We're watching some of these mega cap tech stocks given the bloodshed that we saw yesterday. And really, it continued to see a bit of whipsaw here, right? The likes of TSMC and really here the rest of what we're seeing in South Korea as well as in Tokyo. Look at Tokyo Electron. We're up 17%. So certainly you are seeing a bit of whiplash here and a reversal of these trades. Is it really something that you could say gives us clarity on whether to buy on this dip? I think most guests say, look, it's only been a day. We really have to assess whether, once the dust settles, whether these are still going to be the safety trades of what was the beginning of 2024.
Yeah, that's right. And I think there's a lot of question marks around whether there's still excessive exuberance in big tech in particular, because even though you are seeing a reversal, it's not really recovering all of the losses from yesterday. But today, this is the broader picture using GMM. You are seeing moves again, that equity picture really standing out to us. Yields as well, we've seen those moving around. We are just seeing them moving. Japan, of course, really one of the ones to note in particular. Commodities, again, a little bit of weakness coming across the screen here and continuing to track. Dollar trending fairly steady right now. Malaysian ringgit standing out to the downside. More ahead. This is Bloomberg.
The market got carried away by demanding inter-meeting cuts. It's not going to happen. The Fed will look at the economy and say, yes, it's weakening, but this is not an emergency situation such as the ones we've seen before.
I wouldn't have expected the market to react with such a haste and panic the way it did. And so I think that the Japan story, the carry trade, is actually what's causing a little bit of chaos in the markets. And I think that, there really has been an immediate reaction to that.
We're getting closer towards the end of this kind of manic kind of price action, because it was very much driven by technical factors.
It's good to see that today we have a rebound in the markets, and hopefully this breaks the fever. But I think we're still in fairly uncertain terms at this point in time, given that in some of the regional markets, we're actually still doing quite well on a year-to-date basis, and investors are sitting on profits might be taken to take some off.
Some of our guests there on the recent wild swings in the markets and whether we have broken that fever certainly is still the big question here today. That stock rebound, though, you're certainly seeing that in Tokyo as we get into that lunch break. Nikkei 225, we're seeing gains about 9.4% or so. So, we've lost a little bit of momentum, and we're not nearly close to even recovering from those 12% losses that we saw yesterday. But, things are slowly coming back. But, yes, we snapped at least out of the 5-day gains that we saw in the yen as well. So we're just below that 145 level, and we're still seeing those yields reversing quite strongly here, 11 basis points the upside for your 10-year JGB. In terms of what's really kind of driving that here today, I mean, it's really going to be what were the biggest casualties of this sell-off yesterday. So look at the likes of MUFJ, for example, recovering 6.5% after dropping 16 or so, or double digit, I think 20% from Mizuho yesterday. Now we're seeing a little bit more of a recovery here, but we saw record drops yesterday here as well. The insurers were also part of that discussion, just how much of a tumble that we saw in these financials as well. So certainly, there you go, a bit of recovery there, Bill.
Yeah, recovery. But I think to your point, sentiment is still looking a little bit fragile in terms of the different indicators. One of those, for instance, will be volatility, and we're still seeing that elevated, not at Monday's levels, but certainly still compared to where we've been over the past couple of weeks and months. Trading volumes as well, they're back to their 20-day moving average. Yesterday, they're extremely elevated with a lot of forced selling, perhaps a lot of margin calls as well, particularly over in Japan. And as well, you take a look at the gains so far for the broader Asian benchmark, up around 3%. Yesterday, it was a contraction around 6%. So you're just not seeing that full recovery just yet, even though there is a lot of positivity broadly, a lot of sectors here jumping, the likes of IT, for instance, 4% higher so far. But let's shift now to our exclusive series. This is inside India's Adani Group. Karan Adani is billionaire Gautam Adani's eldest son. He oversees businesses including cement, ports and logistics. Those combined provide much of the critical infrastructure allowing global companies to plug into India's $4 trillion economy. Adani's now planning on taking over seaports in the Middle East, Africa and Southeast Asia as it tries to challenge China's dominance in key trading infrastructure. In our exclusive interview, Karan Adani also dismisses allegations that the group's fortunes depend on their close ties to Prime Minister Narendra Modi.
This man holds the keys to one of the biggest logistics businesses in Asia. Karan Adani is the eldest son of Gautam Adani, the Indian billionaire who built a sprawling infrastructure empire that's pivotal to the country's economic ambitions. He's been handed the reins to some of the most important businesses for the Adani Group, including ports. Karan is visiting the Mundra port in India's Gujarat, the home state of Prime Minister Narendra Modi, whose policy priorities the Adani Group has closely tracked as part of its business strategy. Mundra is where it all started for the group, which is now India's biggest private operator of ports. Maintaining and building on that growth will be a key challenge for Karan. He is one of the 4 family members handpicked to run big chunks of the Adani empire as part of his father's succession plan. However, the firm's meteoric rise has been overshadowed by accusations it's benefited from cronyism. It also took a multi-billion-dollar hit from the explosive Hindenburg research report, with a short seller claiming the Adanis engaged in fraud and stock manipulation, allegations that they've denied. Bloomberg's Antony sat down with Karan Adani for an exclusive interview and asked him about the challenges ahead.
The group's rise has been closely linked to Prime Minister Narendra Modi, but at the same time you are working in several other states with other governments also. How do you do the balancing act there?
Being close to a political party does not necessarily mean that you get the work. You get the work because you are able to deliver, you are competitive in a market, and we have run it in a most efficient manner. You don't have these 3 things, there is no point being close to any political party, or because today's India is no more about giving favors.
When the Hindenburg short seller attack happened, it must have taken a lot of management bandwidth and mind space away from chasing this vision. Now, how did you deal with it personally, and what role specifically did you play at that time?
So at that time, basically my responsibility was 3 things. One is obviously to make sure that business resilience continues, not just in ports but across the group, in terms of our performance, in terms of our operational efficiency, in terms of our capex efficiency. So that was number 1. Second was to ensure that from a leadership perspective, we were completely aligned. There was no critical people leaving during this time, and they were ensuring that we were all working together to achieve the goal, to make sure that we weather the storm. And that's what that was a main priority, to make sure that whatever performance parameters that we have achieved in the past, we beat that during this period.
Karan Adani there, speaking exclusively to Bloomberg's Anthony. For more, let's bring in Ankita Shah, Vice President and Equity Research Analyst at Elara Capital. And she focuses, of course, on the port side of the industry and obviously infrastructure and the like. It's great to have you, Ankita. Obviously, they have a lot of ambitions, whether it's global expansion. They have a long range of networks here, everything from freights to warehouses to ports and the like. You're quite optimistic about the stock overall. I mean, what do you think is going to be driving this company to maintain some of those market share gains that they already have?
Yeah. So thank you for having me firstly. Adani Ports is a large, conglomerate which has nearly decades of experience in the port sector. They have a large portfolio of ports across the maritime structure of India. They have seen an almost 20-25% of cargo volume growth over the past 3 years. With the current capacity of 600 million metric tons, they are operating at nearly 70% utilization level at around 400 million metric tons. The target is to go towards 1 billion metric tons by 2030, which is nearly a 15 to 20% CAGR further going forward. Now, the good part is that the company is growing almost 2 to 3x that of all India average growth rate. So all India average growth is at around 5 to 6% in port volumes, and Adani Ports is growing at a much higher rate than that. We believe this rate is likely to continue because of the presence at the major ports across the East Coast as well as on the West Coast of the country. Also, they have an integrated value offering to the ship liners in terms of the logistics business as well. That gives a distinctive advantage over other players. To continue on the growth story, they have also now forayed into international markets with Haifa port, presence into Tanzania, Sri Lanka. These are the countries that they've already forayed into, and there are other that they are evaluating opportunities. So that will likely to lead, continued growth going forward. We believe out of the 1,000 billion ton, of almost 80% will be organic growth, and balance will be international growth. Yeah.
Is there any risk, Ankita, do you think, of Adani Ports scaling up at the same time? We've got a lot of concerns around the risk of global recession and waning global demand.
Yeah. Yes, export-import volumes is a risk for the company. But we believe, given that India is doing a lot to improve on its exports in terms of Atmanirbhar policy, Make in India, and coal demand. So on those parameters, we believe export-import volumes will remain healthy. Also, with the integrated business approach that they have, they will be able to attract more volumes on their ports. Other risk could be geopolitical issues and any kind of risk that they face in their international business operations. That could be a risk to the company.
You cited port margins as something that you need to closely watch. I mean, obviously, we saw in the earnings last week, they were up about 72%, I think up some 30 basis points from a year ago. Just given the industry challenges, though, can they maintain those port margins and stay resilient?
Yeah. So on the domestic business, 65 to 70% port margins can be maintained because of they have a lot of scope for expansion also at the existing ports. That will ensure that the profitability is maintained. Also, they are doing a lot of digitalization initiatives and cost rationalization, which will ensure that profitability is maintained. On the international ports, we are yet to see whether the similar kind of profitability that is there in Indian ports is maintained or not. So we believe, at least 60% plus is what margins that they are likely to sustain in the port business over the medium to long term.
We were just hearing now from Karan Adani, who, of course, is someone who is, of course, Gautam Adani's eldest son, but someone who could be a potential successor to the entire group. We spoke to him about the impact of the Hindenburg research report, which did have quite a bearing on the share price performance of Adani Ports in particular. Do you see that the worst of that short seller report is behind the company now?
Yeah, if you can see, since the last report to now, these group stocks have almost nearly more than doubled, not just Adani Ports, but other group stocks as well. This speaks about the strength of the underlying businesses that the group has. So we believe, the company is now back on the growth trajectory and has announced a large capex of almost 10,500 to 11,000 crores in this FY25, which means that, the company is back on the expansion spree. And the issues of the Hindenburg is behind us, as we see it now.
Can you talk a little bit more about the expansion plans as well? I mean, they're targeting Middle East, Africa, Southeast Asia. Currently, I mean, the infrastructure side of things, there are still some barriers, right? If you take a look at traffic, container traffic, for example, I think it's only 10% of what China does. In some ways, poor connectivity has also been a reason why the country cannot integrate into global supply chains. So, do you think India and Adani Ports has what it takes to really sort of counter this dominance that China has on trade infrastructure?
Yes. So to counter this, as a country, I mean, we are developing a Vadhavan port, which is going to be the one of the largest port in India. This will have almost 10 million TEUs kind of capacity of container volumes in the country. This will also be a gateway to Middle East and Europe ports, to come into India, and being western coast of the country is the largest container hub for the country. So we believe we have all the armor in place to grow the export-import business, and we are creating incremental capacities to harness that demand.
Ankita, thanks so much for your time this morning. That was Ankita Shah, the Vice President, Equity Research Analyst at Elara Capital. And our special coverage of the Adani Group continues all of this week. Tomorrow we're going to be hearing from Gautam Adani's nephew, Sagar, who oversees the group's power businesses. Our coverage culminates with a special report on Friday that's at 11:30 a.m. Hong Kong time, with an encore presentation at 7 p.m, which is 4:30 over in Mumbai. We'll have more ahead. This is Bloomberg.
Well, there's been a lot of, I guess you could say, wealth destruction that's happened in the last few days as well. You take a look at how Jensen Huang has been feeling it in the last few days. In fact, the Nvidia boss offloaded almost $323 million worth of shares in July, just ahead of that wider tech sell-off. And that really means that Huang has sold almost $500 million of shares since June. Now, the sales are part of a trading plan he adopted back in March. Nvidia shares have tumbled 14% over the last 3 trading days, including 6% on Monday. You stick to Nvidia and you hear the likes of Cathie Wood, ARK Investment CEO, and she continues to defend her position in that early sale of shares in the tech firm. Speaking on the latest episode of Bloomberg's Tiger Money podcast, she also told us why she still believes in upside for Tesla.
First, on the Mag 6 versus Mag 7, we didn't create the Mag 6. The market threw out Tesla from the Mag 7 when it started underperforming this year. So that wasn't our concoction. That was the market generally saying, okay, we guess Tesla's not in this group anymore. And we were kind of happy about that. We didn't want it to be.
Side point, the reason I bring that up also, and I want you to be able to talk us through that, the macro environment that you seem to be describing that we are headed into of lower rates, doesn't that benefit all 7 and not just Tesla, for example?
If you look at the valuations of these companies relative to where they were pre-COVID, unlike our portfolios, most of the stocks in our portfolios, which are back to 2018 levels, some even 2017 levels, think about that. And these stocks are at all-time highs. Will they benefit as much as ours? Highly unlikely. Highly unlikely. We think it's more like that 1930s example. Now, to answer your question directly about would we have, we sold and it has tripled since. We were in for the first 100-fold increase. So we rode it up 100-fold. Would we have liked another triple? Sure. I mean, that, and if we had known it was going to triple, absolutely. But here is the most important question. For Nvidia to deserve where it is right now from a valuation point of view, other companies out there must be having phenomenal results, provocative results that are turbocharging them and moving forward. We think we have a lot of companies in our portfolio that will enjoy the AI swoosh, but it is going to take time. And I think that is what a lot of people are missing. And this is what we were thinking as we were selling Nvidia and moving more into Tesla.
That was the ARK Investment Management CEO, Cathie Wood, on the Bloomberg Tiger Money podcast with our co-anchor, David Ingles. And you can find the full episode now through these channels. That's a new episode dropping every second Tuesday. In other corporate stories that we're following this morning, a US federal judge has ruled that Google illegally monopolized the search market through exclusive deals with Apple and others to make its search engine a default browser. The ruling hands the government a victory in its first major antitrust case against a tech giant in more than 2 decades. Attorney General Merrick Garland calls it a historic win for the American people, while Google says it plans to appeal.
Elon Musk's X, the social network formerly known as Twitter, is closing its office in San Francisco. A source says CEO Linda Yaccarino made the announcement in an email to employees. Workers will be relocated to an existing office in San Jose and an engineering office in Palo Alto. The move marks the end of X's history in the city where Twitter was founded nearly 20 years ago. Plenty more ahead. This is Bloomberg. All right, we are going to be watching very closely how Wall Street wakes up here this morning, just given that we are seeing recovery across these Asian markets here today. The VIX, after surging yesterday, are we likely to see a little bit more calm when it comes to sentiment? NASDAQ futures are actually punching up close to 2% gains here right now, so it looks like we could be seeing a bit of stabilization after it was a $6.4 trillion wipeout that we saw when it comes to global markets as well, Belle.
Yeah, and of course, watching that rebound in the Tuesday session so far in Asia. Japan closed right now for the lunch break, but we are just keeping an eye on what's happening in futures. And it is moves here indicating to, again, we'll see those gains extending or holding into the afternoon. The big question, though, really is you've got volatility that's still looking elevated. You've got trading volumes that are petering out. Retail traders really took the brunt of that yesterday. There was a lot of question marks over how much margin selling was really coming through. So how further likely are we going to see that real recovery not only extending to close the gap where we were yesterday, but also just how much volatility we can expect in the days ahead? A lot of question marks over the BOJ. Did they really ill-time that rate hike last week?
Yeah, given that there is a bit of a slowdown, not just in their economy, but yes, the rest of the world here right now. And does that unwind and carry trades? Does that continue on to really roll these markets? You know, there's still a lot up in the air, obviously, here, but today at least we're breathing a little bit more easily. We're watching some of these China agricultural stocks as well. We've certainly got some news here on really that's really driving some of these gains. So the state funding support pledge. So that's why you're seeing some pretty outsized moves there in China and the A-share market. And your global macro movers looking like this. We're just a few minutes or an hour or so away from that RBA decision. That's certainly the next thing to watch in terms of how central banks are viewing this market sell-off here, and does it actually change the reaction function moving forward here. But yes, we talked about that rebound that we're seeing in North Asia here today. You're certainly seeing that in Korea, in Tokyo. Singapore's not playing ball, but yes, the red that you're seeing is really across sovereign bonds. So continue to see that inverse relationship between equities and fixed income here this morning. 30-year yields are spiking really in Japan. We have a 10-year bond auction in Tokyo later on today as well, which is worth watching. And of course, that the short end of the Aussie yield curve is really kind of defying what we're seeing here right now. Dollar is a bit stronger across the board overall, but yes, the fact that the yen is coming off and snapping out of 5 days of gains is certainly helping to lift sentiment here this morning. Commodities, though, are still in the red, but looks like Europe, looks like the U.S. could wake up to a better session here today. That's it for us here on the China Show. We got Bloomberg Markets Asia coming up next. Stay with us.